Symphony is in focus. The company recorded its highest ever sales in Q2 with a 25% revenue growth, even as its margin contracted by over 400 bips. It's a 420 bips margin decline on a year-over-year basis. To discuss all of this, along with what festive demand is looking like and the export opportunity, Nrupesh Shah, who's Executive Director of Corporate Affairs at Symphony, joins us now. Mr. Shah, good morning and thanks a lot for joining us. First off, a very happy Diwali from all of us here to you, your team and your family. And thank you for joining us today. If I can begin by asking about the margins exactly. We've seen a 420 bips margin decline. Can you tell us what's really going wrong over here and what is the guidance for margins going forward? Are you likely to continue to see this kind of pain?
Thank you, and wishing you, your colleagues and all the viewers very happy Diwali. So first and foremost, as it can be seen at a console level as well as at a standalone level, for 6 months, first half gross margin and EBITDA margin is higher than previous year. Of course, in Q2 September quarter, EBITDA margin has shrunk, and mainly on account of 3 reasons. Number one, during September quarter, we have undertaken one time some of the major market research, product research activities, and that has resulted into almost 2.5% of the top line by way of off-season, those kind of expenses, but treated as revenue. Secondly, in summer of 21, there was huge unprecedented tertiary sales that has resulted into, as per accounting standard, incremental warranty provision. And number 3, in about 4 range of our air coolers, in all 20 plus SKUs, we have strengthened and upgraded those models substantially for our long-term value accretion. However, we haven't yet taken any major price increase despite cost increase because of upgradation, but that price increase will be done in a calibrated manner, and result of that will be seen in March 23 performance as well as next summer. Having said this, as far as EBITDA margin percentage is concerned, on a console level, year as a whole, we expect almost to be in line with what it was pre-COVID at a console level.
Okay, so you spoke about calibrated price increases from here on. Could you tell us the quantum that you're planning to take over the next 6 months? And what's the kind of margin range, the aspiration for, say, Q4 FY23 or Q1 of FY24?
Obviously, our margin aspiration is on a console EBITDA level, almost in line with what it was pre-COVID. But that will happen in a calibrated way because we can't have a knee-jerk reaction to optimize everything. We have already undertaken somewhat price increase across the product range, which varies from 2% to 12%, and that will keep on happening month after month and quarter after quarter. And maximum result of that will be seen in March quarter and next summer.
2 to 12% is the price hike you've already taken or you plan to take?
We have already taken price increase in the range of 2 to 12%, but in addition to that, there will be further calibrated price increase so as to reach to EBITDA margin percentage to pre-COVID optimum level by next summer.
Mr. Shah, revenue from India, the domestic market, has shot up exponentially this time. I mean, I think for H1, the first half of the year, it's come in at 63%, but it used to be closer to 50%, right, earlier. So is it that the Indian market has done exceedingly well, or is it that, globally you're seeing maybe some sort of headwinds in other geographies?
You are absolutely right. So Indian market has done extremely well. We are completely out of the woods of 2 bad years of COVID, and this has been highest ever. First half and quarterly top line. As far as rest of the world is concerned, it is almost flattish. And we expect, considering very robust off-season collection, that momentum to continue. And we are really witnessing that across the geography, across the models, and across our various business verticals.